Obviously, a lot of what we've been talking about today, honestly, it's about risk. I mean, it's about lots of other things. It's about our children's future, and it's about finding really great stuff and wonderful stories. But at the heart of a lot of this, and whether it's engagement or stock selection, is how we're actually managing risks going forward. So that's what this second session is going to be focusing on, and we'll be looking at measuring and managing risk, ESG risk, and what people think are the biggest risks, and how useful are the data services. I mean, I effectively run a data service, right? I don't really see it as being that, but I like to think it's useful, and I think the answer is that, there's some bits are good and some bits are bad, and let's try and unpick that during the course of this session if we can, please. So perhaps I could ask everyone to just introduce themselves, maybe take a minute or so just to go through who you are.
Thanks. My name is Glenn Anderson. I'm looking at sustainable investing strategy at Fidelity International. We are a global asset manager investing across asset classes and geographies. So that means we have to also look at solving sustainability problems across equities, across fixed income, across multi-asset and private markets as well.
Hi, I'm Suresh Mistry. I'm head of sustainability at Alquity Investment Management. Alquity is a business that's focused around delivering responsible investments through a high-quality ESG process, but also as a business giving back. So 10% of our revenues go back to support social development projects where we invest. So thereby kind of creating a virtuous circle where we increase the economies in which we're investing to improve the returns over the long term for our investors, and then invest those returns more responsibly going forward. So that's the basic business model behind Alquity.
Hi there, my name's Alex Game. I'm a fund manager and an ESG officer at Unicorn Asset Management. We're a long-only UK small and mid-cap investment house, so only specialise in that part of the market. I think this topic that we're discussing today is particularly interesting to us because investing in small caps certainly has many challenges when it comes to investing from a ESG angle, but we think there are also some really attractive opportunities.
Hi, I'm Clare Wood. I'm a portfolio specialist at Stewart Investors. We've been around for 20 to 30 years. We're long-term, bottom-up active equity investors only. We invest across Asia-Pacific, global emerging markets, India, European, worldwide strategies. And we've launched our first sustainable fund nearly 20 years ago, and that really grew out of our focus as long-term investors. So our approach is very much to try and find high-quality companies that are run by exceptional people and have strong balance sheets so that they are really well placed to contribute to and benefit from improvements in human development and sustainable development.
So moving on to the first question that obviously you guys have had the questions in advance, but Glenn, maybe I can ask you to lead in this one. If you're running an ESG fund or a sustainable fund, responsible ethical fund, whatever, talk to what you do, what are you managing risk-wise that other people maybe don't pay quite so much attention to? What makes it different? What risks? Why should people here even think, oh yes, these guys are better at managing risk than anyone else?
I think the framing of the question is really interesting. So, I mean, the way I'd look at it is rather what additional aspects we are looking at. I don't want to go out and say that these are not looked at by anyone non-ESG, but at the essence of what stands behind ESG, to me, this is a lot more than just a rating. A rating is a useful and helpful expression of ESG, but ESG to me is tangible. If we think about what constitutes those three factors, we're looking at, things like emissions, things like how the board is performing, how are we ensuring that there's the right level of accountability and governance at companies to achieve and manage risks themselves. We're looking at, again, things like labor practices, human rights issues, which are very practical challenges that companies are facing across the world. As an investor, we also need to take a financial lens on these things. So it's not just about, I guess, saying things are good or bad. It's also about understanding what are the implications of these on the investment performance. How will these materialize?
So impact on returns?
Not only. All of these can potentially materialize through things like shocks to commodity prices, what we've seen over the last couple of years, policy angles, carbon tax. We're taking a longer view on these. And I think that's a key aspect in terms of how we're approaching ESG, is we're trying to look at out to 10 years on how environmental and social performance of a company.
So something that differentiates your fund would be timescales, you think?
I think that is a strong factor. There's a big difference in the market from those who are just trying to look at how a company is today. We're trying to look beyond that. Really, how will this company evolve on its environmental and social perspective? How its profile is likely to materialize through that timescale, and try to take a view besides just where it is today.
Okay, interesting. Anyone else like to expand on that? Sort of things that our funds do differently from other funds, and dial up and dial down?
From our perspective, I think ESG risks focus on one aspect really quite strongly. It's the license to operate for a business. That is the risk we're considering. Their environmental behavior, their social behavior, their governance gives them the license to operate. Most non-ESG funds are assuming that's a given, that these companies can continue to operate whatever they're doing as long as the financial returns are there. ESG actually shows you that these are the risks that might stop that company from operating, whether it's a government regulation, clients moving elsewhere, communities rallying up against them. So we're looking at those risks. And if you're looking at a company through an ESG lens, what that gives you is a proxy on the quality of the management team that is running that business. The general assumption is that management quality is because somebody's got an MBA or has spent 20 years in that industry. But actually looking at these kinds of risks and the companies managing those risks gives you an indication as to how good that management team are in terms of forward thinking, not just backward looking thinking. So it gives you that opportunity as much as it helps you understand the risk. And there was a bit of data, I think this is quite old now, 8 years old, that showed that companies that focus on ESG materiality, it's quite different from focusing on ESG, because you can do lots of things on ESG, but none of it's material, so it's irrelevant to your financial performance. Companies that focus on material ESG deliver something like 6% alpha compared to companies that don't. That's a meta-analysis, HBR did it, it's back in 2015, it's a long old study. So it's financially the right thing to do.
Yep. Alex, for UK small cap?
Yeah, I'd certainly agree in terms of the quality of management. That's a huge area of focus within our investment process. And particularly within smaller companies, the management have a huge influence on the direction of the companies that they're running. So, a big focus for us is spending time with those management teams, going to visit their operations. And, one of the beauties of investing in small caps, we can visit 2 or 3 of their factories, and in those visits, we would have visited 80-90% of their manufacturing operations. So that gives us a very clear, transparent view of the impact of that business, but also the culture within the business. So we can meet not only the CEO, but we can meet the next tier of management team. We can speak to the people on the shop floor. And that gives you a really good indication of the values of those businesses, and ultimately, the companies that make the strongest positive impact over the long term are those that have those strong culture and values embedded throughout their organizations.
So maybe Claire, would you like to develop that from what Alex was just saying about the mechanics of how you do it and how you look at the risk and how you work?
Yeah, absolutely. So as I mentioned, our sort of focus on sustainability came out of us being long-term investors, and so we're very bottom up. We look at a company, we're really looking for companies that we can hold for 10 years and that are really going to be supported and drive a lot of growth out of that sustainability focus, benefiting from the drive in sustainability. So we look at sort of 4 main areas. We first look at the context that the company's operating in. What are the problems that it's trying to solve? If we define sustainability as trying to drive human development while keeping us within planetary boundaries, there are a lot of problems that need to be solved. There are a lot of basic needs that need to be met. We need to be doing more with less. So there's a lot out there that companies can be doing. So we look at that context. We look at the ethos, so this goes to the quality of management that Suresh raised. If the management is not treating its stakeholders right, how are we going to be confident that it's going to treat us right? We're also a stakeholder. So that ethos and quality of management is really important. We look at the products and services that it provides, because, I mean, we'll get onto ESG data later, but there's a lot of stories about companies that have great ESG ratings that don't provide anything useful for society. So we're very focused on the products and services. And then lastly, there's the operational impact, which probably is the area which more classically sits within the ESG data space. But that's only one of 4 different areas that we look at when we're looking at firms. And we, being bottom-up stock pickers, we meet with management regularly because it's so important to really understand what's going on at the company and how those risks are being managed.
Thank you. Alex, would you like to just touch really briefly on sort of what the hardest part of this is, or any of you also jump in on, you know, what's the bit that's really has you scratching your heads and going, actually, I'm not really sure what the answer is to this?
Yeah, I mean, I've touched on it already. For investing in smaller companies, it's the lack of reporting and disclosure when you compare them to a FTSE 100. And clearly a larger company will have teams of people producing reams of glossy brochures with, you know, various different case studies on. For smaller companies, it's much more difficult to have that resource to communicate to investors, to communicate to you know, the broader market, just some of the good work they're doing. So clearly that burden is then translated onto us as investors to try and really do that due diligence to make sure that the company is not having an undesirable impact in terms of on the environment, on the communities that it operates in. So from a due diligence standpoint, clearly there's a huge amount more work that needs to go into understanding these risks when investing in smaller companies. But I would add to that and challenge that by saying, you know, people that invest in this part of the market are used to investing that way, used to investing with a lack of you know, reporting information. So it really builds on the skill set of investing in the space anyway.
Yeah, I wanted to add as well, I think one of the biggest challenges we're facing on a daily basis is how to move on from the status quo of where we are today on environmental, social performance, and how to see improvement on it. For us, engagement is a key part of it, and one we're really trying to use to get more information and disclosures from companies so that we can have evidence-based discussions with them in terms of where they are, but also to use those discussions to start opening up topics of where they are going to be. What are the targets that they're setting? What are the controls they're putting in place? And we've found as well, I think, similar challenges in terms of how resource intensive that is. And frankly, we've had the benefit of having a big research analyst platform to use and leverage for that, which enables a lot more of those conversations. But it's really how to keep that structure and keep that momentum going with companies, because we don't want to just know where they are today. We want to engage and support that improvement on a continuous basis.
Yeah, thank you. Can we build on that then, into the sort of international perspective and also different asset types, and maybe just spend a few minutes between us, maybe with Suresh kicking off. Just so you know, it's very easy to say we do this across our investments, but some countries are just a bit different from other countries. You know, we're not, sorry, I beg your pardon, that's me holding the mic too far from my mouth now. Sorry, Jeff. So international aspect and also different asset types. So Suresh, would you like to kick us off?
Yes, of course. I think first of all, every asset class, everybody who invests in different asset class will say their asset class is unique, but as ESG investors, we're all trying to do the same thing. We're all trying to deliver returns, and we try to do that and support a just climate transition. So our objectives are the same, whatever asset class you're investing in. And I mean, there was some research out only this week that showed that ESG ETFs don't deliver returns over, what was it, something like 10 years. So first of all, the first thing it teaches you is that actually data at a kind of a macro level or a data provider level is no use at all in terms of doing ESG. So you have to be fundamental. And so whatever asset class you're in, if you're not doing fundamental analysis, why bother doing ESG at all? You might as well just hand over your money to somebody else. So that's my start point. So in emerging markets and small cap in particular, and I think Alex will concur with small cap generally, you have to go and get the data yourself. So the fundamental piece is clear. The second piece is around being focused on what I would call double materiality, and I'm sure this audience is familiar with it, but for those who aren't, you know, a lot of data providers provide single materiality, the impact of environmental issues or social issues on the financial performance of the business. That's critical for a return, that's absolutely important. But as an ESG investor, what you also care about is that business's impact on society impact on the world and your ability to deliver a just climate transition through that business. So double materiality has got to be something that we have to consider alongside this idea of fundamental analysis. And finally, and particularly for emerging markets, it's about context. You know, our values stay the same, but the context in which we operate is different. And so we need to understand that. And sometimes we do take a very Western doctrine kind of view on emerging markets. This is how we see the world, so you must operate in the same way. And it just doesn't work like that in many markets. And you have to understand the context you're operating in. Doesn't mean your values change. Your values stay the same. It's just your application changes. So that's the way I would say it changes in my asset class anyway.
Okay. Anyone else like to comment on the differences? Maybe over there first, or no? Okay, back to Glenn. Sorry. Or, yes, go ahead.
Yeah, I'm happy to sort of comment on the emerging markets piece. We've obviously been investing in emerging markets for a long time. I think one of the things that we've always found interesting is that there might be an assumption that actually emerging markets companies are laggards in sustainability, but certainly, you know, we found that in many cases they're leaders in sustainability, and certainly in the impact that they're having in the countries.
Is that recent, or is that?
No, that's from a while ago, when we consider HDFC Bank in India, amazing bank, doing an awful lot to economically empower people, help them buy their own homes. We don't invest in any developed market banks. At the moment, we find the best banks in emerging markets to invest in, for example.
Yeah, that's really interesting, because it's very easy to take a very Western view on all this stuff, isn't it? And they've been in lots of portfolios for a really long time. I know that. Are there any other examples you'd like to illustrate with that kind of thing? Because I think that's really useful information for people.
Yeah, I would say we're talking about plastics. So we were concerned several years ago we were invested in a number of consumer goods companies in India, and we were concerned about the level of plastic pollution that was going on. It's a big problem everywhere. It's very visible in India. You know, all the plastic bottles and containers wash down the big rivers and into the sea. So we commissioned a piece of research to be done on plastic pollutions, and we actually found that, the leaders were some of the Indian consumer goods companies, the local ones, less so the multinationals. And that was really interesting. And that led us on to a piece of sort of collaborative engagement with Indian consumer goods companies around plastic pollution. But again, it was surprising for us to see, and very nice to see, that actually some of the Indian companies had been thinking about this more and better than, say, some of the bigger, more famous consumer goods names that you could mention.
So I'm just going to say I'm going to open for questions on this part of this panel session after Glenn has made a few points. So if you'd like to think of any questions while Glenn even starts to talk.
Yeah, there's been actually also a recent piece of publication on how important it is to tailor engagements depending on who is the target of those, and this is what we're also seeing in our practices. It's really important to be able to contextualize the position of the company and almost the motives and the incentives for a company's performance on environmental, social, governance factors, and we see this on a daily basis as well. So while there's a global platform, global priorities of what we stand for, what's our value set, the conversation, let's say, on gender diversity in a UK boardroom is fundamentally different than if we go, let's say, to a Japanese boardroom. And it's important to be able to relay those messages in a way that lands understandably there, because otherwise, I guess, it makes no sense for us to fly out from UK to there, and instead is actually a lot more practical if we have people on the ground doing it.
So and it's just going to sound very patronizing, presumably, if you get it wrong as well.
Yes, exactly. And there's also a bigger macro context to this as well. Some countries will be much more bound by where their governments are targeting and where they are headed, and they don't want to see themselves diverging from it. So we also see our role, I guess, as a responsible investor to be able to at least help them navigate the complexity of, let's say, if an Asian continental country has a 2060 target on net zero and the whole investor community is expecting 2050, how do you bridge that gap, and how do you still keep on signaling that this is important, but you genuinely understand that difference and want to work together with them to make that improvement matter.
Yeah, really good example. Can I ask if there's any questions on this? We'll come on to rating agencies after, but just only on this wider managing risk bit for fund managers. You've got good international perspectives and very different fund management sizes and approaches. Please, can I take any questions? Seb.
Thank you. So my question is a question around environmental risk. And it seems to me one of the big problems is a disconnect between what economics say about environmental risk and what the science says. So, cheeky question, can anyone describe the albedo effect? Can anyone describe the albedo effect?
I certainly can't, Seb. Thank you for that, but I suspect you might be going to tell us in a moment.
Which is another way of saying, you know, perhaps on a scale of 1 to 10, how comfortable do you feel with climate science? Your understanding of it.
So I think we might be heading into the territory. We've got a scare session just before we break for drinks this evening, where we will have Mike Clark, an actuary, talking about climate risk being massively underestimated by the financial services community, and that if that doesn't leave you needing a drink, nothing will. But yeah, so can we have any comments on thoughts on that?
From my personal perspective, my background is systemic thinking, and one aspect of the climate science which I don't think is well enough understood is the issue of tipping points. That is the big thing scientists are talking about. They understand tipping points, and the financial community just doesn't understand it. It just assumes that these things will happen, and if you stop doing something, it'll revert back. Tipping points don't do that. In a systemic system, any kind of system, as soon as the tipping point is hit, there's no going back. And I think that's the bit about environmental science that the financial and the commercial community and the governments don't get at all. And I think tied with that is the carbon... Oh, sorry, I should put this close. Tied with that is this concept of the carbon budget. We were talking earlier about Rishi Sunak and his move to reduce the kind of net zero target or the trajectory. Trajectory is critical to net zero. It's not about achieving net zero day before 2050, because we're dead by then. We're 3.5, 5 degrees.
Don't say that. Both my children are here.
Yeah, sorry. We're toast. So that's closer to. We literally will be toast by then. But that's the point. Is people don't understand that we have a fixed carbon budget, and every ounce or every atom of carbon dioxide that goes into the environment, wherever it's done, whether it's UK or India or China, it's the same as far as the globe is concerned. And I think that's the bit that frustrates me about the lack of understanding of environmental science.
Yeah, and that's absolutely what the Emperor's New Climate Scenarios report touches on. It's like economists have completely missed what the word tipping point means. Does anyone else want to comment on that? Please. Come in, Clare.
Yeah, I think taking a step back, what we're trying to focus on is make sure that there's an alignment in terms of what is the climate science and what are the conclusions of climate science that we, as an industry, need to look at. I think if we start creating our own IPCC here on the panel, it will probably give yet another outcome that gives maybe somewhat of a different conclusion. As a position of an investment manager, what's important to us is also understand the transmission channels and how this will hit the investments and how this will affect the investment companies, investee companies. And on that, there's, I think, if I rephrase some of the elements that you said, policy risks, right, and economists. So do we see that there's a response, there's likely response from politicians that will affect companies, right? We've just had last couple of weeks a lot of U-turns on environmental and net zero targets from the government. How will that translate itself through to company performance? I think these are sort of the tangible, controllable factors that we're also asking our analysts to embed in how they value these companies. So we have our equity and fixed income analysts are then asked to come together and say, right, this is our outlook on what's going to hit the company.
So I think Claire wanted to come in first, and then Alex, and then let's come back to Seb for another comment.
On the climate science.
If you'd like to. If not, let's pass to Alex.
Go ahead.
Yeah, I'm certainly no climate scientist, but I think in terms of our process, we have, we're a signatory of the Net Zero Asset Managers Initiative, so that is very much embedded into our stock selection process. We need to make sure that we are investing in companies that help contribute to the targets that we've set as a firm to meet. Also, as a side note, we run a large VCT, and I think it's very encouraging where we see the pipeline of companies coming through and raising capital. Quite a big proportion of them are in green technology space, particularly around battery technology. So that's encouraging to see that capital is being diverted to that area of the market that is clearly trying to target that very, very challenging issue that the world's going to face over the next 10, 20 years.
Seb, would you like to say anything else on this? Sorry, Seb is a deeply unopinionated IFA that I know.
Deeply unopinionated. Thank you. Yes, the albedo effect is a tipping point, and it's about the reflectivity of the Earth. And it's a tipping point because as the polar ice caps melt, it exposes dark ocean, which absorbs a lot more heat and doesn't reflect things back. So I just think we can't understand the risks that we face unless we understand Year 9 science. I stole that from a Key Stage 3 revision book of my daughter's.
Fantastic. And so with regard to a lot of that, the reports that have come out recently from Carbon Tracker and also from the Institute of Actuaries, they're on recent blogs on my site. There's a couple of blogs I've done on them recently, an article I've written on it summarising some of that, plus go back to the original source material as well. People are waking up to this, and as I say, you will hear more on it this afternoon, but in terms of risk, that kind of stuff's the mother of all risks, for sure. And it needs to be understood a whole lot better. We've got to get back to the science. Talking of needing to get back to the science, I'm not sure that's the most genteel segue, but ratings agencies. What do we think of rating agencies in this area? How useful are they? My view is that everyone's trying to do something good, but some of it needs quite a lot of finessing, and it's getting better. But who would like to perhaps start on that? I think actually I'd put on my list for Glenn to kick off. But so data and rating agencies. How often do you use them? Do you use them?
We do use rating agencies, but I'd reframe the naming of them more broadly to ESG data agencies.
Correct, sorry, yes.
And the purpose that they've tried to serve is establish a like-for-like comparison. And I think in some ways and parts of the market that is very useful when you do want to get a broad overview on certain criteria. Where a lot of discretion needs to be applied, and the reason why we at Fidelity have our own ESG rating as well, because a rating is just an expression of views, methodologies, and values that somebody who's drafted that methodology has expressed. And so for us, given we need to work with a lot of analysts and a lot of active portfolio managers, we discovered that we needed our own specific ways how we analyze companies, what we expect more from them, and that's where we found a lot of differences to the likes of MSCI. MSCI only looks backward. MSCI penalizes for disclosure, for the lack of disclosure. We take a different view on that, and so I think the net benefit of having why I said ESG data agencies is they do help to collect information across the market. They do help to provide estimations where data is unavailable, but it's a lot more about what do you do with that data. So I think what the net benefit of that is the support of having sort of apples to apples ingredients of it, but it definitely shouldn't be the recipe for how to make the apple jam out of them.
Yeah, I would say, I think the market, rightly or wrongly, views ESG ratings similar to credit ratings, and I think we need to get past this view that ESG ratings are almost like credit ratings. They are independent views of a business's impact and their performance versus a range of KPIs. So for us as investors in small caps, ratings tend to be less relevant, so coverage is generally a lot more sparse down that part of the market. Quality is generally not great, and there have been some instances over the past few years where fairly large rating agencies have completely misinterpreted the business of one of the companies that we may be invested in. And that leads to a round of engagement between ourselves, the companies, the rating agency. And in one instance, we saw a significant upgrade almost overnight as one of those rating agencies reappraised the business. So I think in many ways they've been positive in the fact that they've tried to bring a uniform approach to appraising companies, but at the same time there are challenges. And I think certainly in terms of the transparency, in terms of how some of these ratings are calculated, are formulated, that could certainly improve. I think it's a frustration of ours, it's a frustration of the companies that we invest in and we speak to, when they are marked down, sometimes unfairly, and are not necessarily being provided with the information that they are being marked down for.
So Suresh, and then maybe Clare, and then maybe we'll open for questions on this. I think it's quite a good topic to discuss.
Yeah, it's a great topic, and we're very lucky this week. The FT did a long article on exactly this subject, and I kind of listed all the reasons why they said data providers are no good, and it was kind of like a black box approach.
I've not seen a newspaper this week.
Conflicts of interest because they sell consultancy and indexes on the back of it, single materiality rather than double materiality, unregulated, unaudited data, market cap bias because big companies can employ consultants who can fill in the forms. That gives them better scores, whether they're doing what they're doing or not. So there's this whole long list, and the one thing I can add to the pros for data providers is exactly what I think Glenn said here, which is data. They have the data that many of us do want, and so if you can get that data, and I think that's the opportunity in this data space, is can we democratize that data? Because that will have real impact on transition and our ability to support that.
And we know that clients are interested, right? So it's worth spending the time on it, knocking it into shape, making some sense of it and rolling it out.
Yeah, absolutely. And can you, excuse me, Julie, I'm going to get on my soapbox a little, not just on ESG
Sure,
data providers, but fund ESG data or reporters and assessors. Because as an asset manager, I have a real gripe about this. That list of things can be applied to people who rate funds, excluding SRI services, because I know you guys do provide actually that information. But the number of people who rate funds who I've had to have conversations with, and it's a black box. You tell them what you do, and then the outcome is just this random outcome that is based on, like we say, their values, their perception. And so it's not just ESG data providers. So if you're advisors and you're IFAs and DFMs in this room, this is the kind of stuff that you'll be looking at as well. And you need to ask the same questions we're asking of the ESG data providers to the people who are doing ratings, fund ratings.
Yeah, I'm quite big on transparency. Everything we collect is out there on our site for you to all use for free, and I won't even catch people's email addresses because I'm desperate for people to be able to find this stuff really easily, but it's a massive issue, isn't it? They're calling for transparency but not being transparent themselves. So, Glenn.
I'd almost add to what you're saying is I think there's a false belief that one can find the right ESG definition or the right ESG assessment, and that will hold as the universal truth, similarly to how you can have a very objective credit rating. But the reality is, I think if we tried to have one definition of ESG across this room, we wouldn't.
No.
And that's why that transparency is so important, to ask that question, well, what out of all of this is it that I'm looking for on ESG?
Real information, Clare.
Yeah, I would say we don't use ESG data from data providers in our investment process. Everything we do is bottom up and understanding what the company does. But the transparency point, I'm not going to rehash the FT article either, because I agreed with it along with Suresh about the challenges. But the transparency point is very important. So we have two internal frameworks that we use to assess companies and how sustainable they are. There's a human development pillars, which we developed internally based on UN Human Development Footprint tool. And we use something called Project Drawdown, which is a sort of a taxonomy of climate solutions. So we assess every company as to whether they're contributing directly or enabling towards a climate solution. And importantly, we make all of that information, every company that we invest in, if you go to our website, there's a tool called Portfolio Explorer. Every company is on there. We tell you how it meets the human development pillars, how it maps against Project Drawdown, how it maps against the ESGs, what we like about it, the key risks, and how we're engaging with that company. So anybody can see across all of our companies how we assess them.
Can I just add in, it's an extraordinary tool. It was actually, so he's looking at his phone, but it was my son George that pointed it out to me. a couple of years ago, and it's extraordinary. It's really useful. So that kind of thing, I would encourage any fund manager who can to do that kind of thing. Can I open for questions now? Because this is quite a big topic, and I'm guessing. So if we could get the microphones across to a couple of people here. So gentleman at the front and lady at the back there, please.
Shall I go first? I'm ready.
Sure, please do.
Yep.
Please do.
Okay, with Quilter's Wealth Select removing a fund yesterday for having some historic supplies to a vapes firm, as far as I could make out. Suresh mentioned we've got the carbon budgets coming. Anyone who seriously believes in climate change knows that time is going very rapidly. As IFAs, we have to look at hundreds of funds, thousands of funds theoretically, possibly hundreds of fund suppliers. You all do your own thing. Stuart, I agree, got some good stuff. We have got no chance whatsoever of looking at all that sort of information. We need industry standards rapidly, because in reality, most advisors will not be as keen as people here. How long is it going to be before we actually have some systems that work?
I'll jump in on that one to some extent, because obviously the work I'm doing with the British Standards guys, writing a standard for funds to try and get at least the same information out across funds, which, as I said, I'm big on transparency. The first step of that clearly is to just get the information out there. And there's also, on the advisor side, you may have noticed, there's a couple of us here who are involved, but the PFS, so the IFA side of the CII, starting work on this area as well to try and get standards that would help advisors in this area. So please get in touch with myself, and let's bring you in on that if we can, because it is really tough, and no one of us is going to crack it on our own. So we hence working with people like the PFS. But other comments on that?
I think I'm fairly positive in terms of the outlook of these getting solved. We're just past the first wave of formal TCFD disclosures in the UK. There is also now a template called Carbon Emissions Template, CET, that is looking to align fields and values that are expected to be disclosed by fund managers. And so I think that really is the first step of having that data, which then I would hope as well supports services and solutions that will be able to use and leverage that to make it more usable.
You have my sympathy, because I absolutely understand the vast array of products and descriptions you see. The only tip I would give is try and be curious about the values of the manager, not the product. Think carefully about who you're giving your money to, not what the product is the money is going into, because that will actually give you a lot of indication as to the decision making within that organization. So focus on their values. Are they aligned to yours? Are they aligned to what your clients are looking for? Because that's a pretty good proxy for what you might find in the fund afterwards.
Completely agree.
Yeah, I absolutely agree. We need standardization. You as advisors, as fund selectors, need standardization to help you make decisions. We need standardization when looking at companies. The companies need standardization to know how to report. So it's crucial. And clearly the work that the FCA are doing at the moment, we welcome that. And some of the other initiatives, TCFD, for example, there has been a movement in that direction. So that's all positive.
Can I ask if there are any other questions? We're into the last couple of minutes of this session, so if there are questions, please, now's your opportunity. At the back here. Do you have a mic? Yes.
I have a mic, yeah. It's Helene here from Premier Miton. Just going back to that, kind of the biggest risks being climate change. I was wondering whether any of the people on the podium use the implied temperature scores as part of their investment process.
We've done the analysis, and it didn't look pretty, if I'm absolutely honest. And then when you actually look at the underlying data, you realize that, again, recently reported, I think something like 95% of companies don't actually align with 1.5 degrees climate change anyway. Right, so actually our investment universe is impossible to actually be at 1.5 degrees if you're trying to be a mainstream equity fund like we are. So the way we do that is by understanding the direction of travel of the companies we're going in, not just today's implied temperature rating, because that's the way we actually try and manage that direction or issue towards climate transition.
Claire?
Yeah, I mean, it's similar. So we're looking to invest in firms that we're going to hold for 10 years that contribute towards sustainable development. The problem with implied temperature scores is they're very static. So they're based on assumptions around the market share that the company has right now. We're obviously hoping that the market share of our companies that we invest in is going to grow substantially. They're very static around the assumption of the sort of industry makeup and what that contributes. If we think 10 years out, all of that has got to change so much that any implied temperature score based on those assumptions now can't mean very much. And so we can calculate, we certainly don't use it for investing. I mean, we got on the data, so our funds typically are about 20% of the carbon of the benchmark, very low because of the way we invest. I can't tell you exactly how much. I've been told not to because it just turns out that some of the data that we've been getting from our external providers is wrong. So we've had to recalculate it all. So there's another risk for you.
Right, Glenn, I'm going to let you come in with one sentence, then I'm going to go to this gentleman here for a quick question. We are actually kind of out of time, but let's just do it very quickly, Glenn.
Yeah, I think in terms of temperature ratings, we've looked at them as well. It feels like a very simple concept. There's a big difference compared to climate science, which was asked before. Most of the climate scenarios do not predict a specific temperature. They give probabilities of a specific temperature being reached. So I feel like there's also a false sense of security if we see 1.6, 1.7, 1.5, 2.3, that's going to be the indication. In reality, most of those scenarios give a range, more than 66% likely to be within 3 degrees.
Thank you. I'm going to let one quick question.
And maybe just a good question to end with. Just given that we've got behemoths, ESG data providers, that really a huge number of investment decisions are currently being based on. What are your thoughts on how we best democratize the sharing of information so that decisions can be made on a very sort of open and transparent basis?
Make it free.
Open it up.
Simple question. I
Lift
think
the lid.
Yeah, well, we've got regulatory authorities who are, going to regulate ESG data providers. Why don't we kind of create a repository? Governments want to lead towards climate transition. That's an objective of many governments. Then why don't we make this a national institution, a bit like the audit office or the budget of responsibility, maybe make it one of the national statistics we submit.
Well, maybe ISSB takes us in that direction, possibly.
Absolutely.
We'll touch on those. I'm being told off. We really are. We're out of time. So I'm going to have to not even let you say your last final few words, but I would say please come and talk to the people on the panel if you have questions and would like to discuss further. But with that, I'm going to ask you also to thank the panel. And